Chapter 8, Part 1, Perpetual System versus Periodic, Journal Entries, Trade and Purchase Discounts. Now, inventory overview. Inventory refers to the asset a company intends to sell. Whenever you buy something to sell, it's called inventory. Has in production for future sales, that's if you make the products, used currently in production of goods to be sold. And when we end up selling it, it becomes the expense account cost of goods sold. Goods in transit. Where the goods are on the way to their destination, between the supplier and a company, or between the company and its customers. Accounting for goods in transit depends on when ownership passes. It's very important when you're doing your accounting because it determines whether you record the cost of shipping. If shipped FOB shipping point, title transfers at shipping point, which means that the buyer has ownership the minute it leaves the dock. If shipped FOB destination, it does not transfer to the purchaser until it is received. So it stays in the seller's inventory until it's received. Now, goods on consignment. When goods are sold to another company with payment only being received when purchased by a third party, then until the goods are sold, the original seller will include the item in their inventory and the holder of the goods will not. So now we're going to look at an example. Based on a physical count, we had 210,000 in our inventory, but we had some other transactions. So we start with 210, and there were goods shipped to Quoc FOB destination on December 20th. They were received on January 4th. The invoice cost was $39,000. Now, since it's FOB destination, they didn't receive it till January 4th. They do not take ownership. Now, goods shipped to Quoc FOB shipping point on December 28th were received on January 5th. The invoice cost $26,000. Now, in this example, it would be included in our inventory, even though we physically don't have it, but ownership has transferred. Now, here's the next example. We had goods shipped from Quoc to a customer FOB destination on January 27th, were received by the customer on January 3rd. The sales price was $49,000 and the merchandise cost $31,000. So FOB destination means the seller owns until received by the buyer. Since these were shipped at year end, they would not have been included in the count, so you have to add them back in because you still own them because you didn't they weren't received until the 3rd, and that's when ownership passed. Now, goods shipped from Quoc to a customer FOB destination on December 26th were received by the customer on December 30th. FOB destination was taken out of inventory and received by the customer by year end, so we don't have to do anything. The next thing is the goods shipped from Quoc to a customer FOB shipping point December 28th were received by the customer on January 4th. Excuse me. All right, so we don't include that because it left our docks. And then the last thing we have is consignment. Now, we have things out on consignment. That means we have to keep them in our inventory, and therefore the total adjusted inventory would be $285. So it all depends on when legal title has passed. Now, periodic inventory. Adjust the inventory account and records cost of goods sold only at the end of each reporting period. Records merchandise purchases, purchase returns, purchase discounts, and freight in temporary accounts. Determines period's cost of goods sold by taking a physical inventory and combining temporary accounts with the inventory account. So cost of goods sold is going to equal beginning inventory plus net purchases, which is purchases plus freight in, less purchase returns and allowances, minus ending inventory. Trade discounts. We ignore them when recording the purchase. Why? Because they do trade discounts because they don't want to keep changing their prices. So they'll say one costs $10. If you buy 100 of them, they cost $8 each. That's a trade discount. We only record what we paid for them. Purchase discounts are different. There are two ways we can record them. The first way is called the gross method. We record the total purchase price and views a discount not taken as part of the cost of inventory. Net method records purchase net of discount, and if not paid within terms, the discount is treated as purchase discounts loss. This is an expense account. And now let's look at an example of the journals. All right, so the gross method. We purchased 1,000 units with a list price of $10 for $6. So we would only record the $6 price times 100, and that would be purchases, accounts payable. This is under the gross method, even though we have 5% in 10 days. So now what we've done is we've paid within terms, so we get what's called a purchase discount. If we didn't pay within terms, we wouldn't do anything. We just get rid of the accounts payable and book the cash. Now, what about the net method? The net method takes the discount off up front. If we paid within terms, it's just accounts payable cash. If we don't pay within terms, we're now going to use that purchase discount lost, and this account can be used and identified either as an expense, or we can include it as the cost of inventory. Either way, it's according to the book, it's such a small amount that it's usually they don't even bother with it. But for this class, we are. So let's look at an example. A company had beginning inventory of 20,000. They purchased 100,000 in goods, 210 net 10 on account. They're using the net method, so they had to subtract out the discount, early payment, paid freight in, returned 5,000. Now remember, we're doing periodic, so we have to use all these accounts. If we weren't, freight in would instead be inventory, purchase returns and allowance would also be the inventory account. And then if we didn't pay within terms, then we're going to use our purchase discount lost and cash. And then we sold 100,000, and that would have been accounts receivable, sales revenue. Now under periodic, we have to figure out what's the cost of goods sold. So we did a physical inventory at month end. So we had beginning inventory of 20,000. We had purchases of 98, freight in of 1,300, purchase returns subtracted out. We have total cost of goods available for sale of 114,300. Now in this example, we're going to ignore the purchase discount lost, and we're going to just treat that as another expense. Ending inventory. So now we have our cost of goods sold. Now we can do our journal entry. And what we have to do is we book cost of goods sold. We book our inventory, which is the 34,300. And now we have to zero out all these temporary accounts, which are purchase returns, freight in, purchases, and beginning inventory. That's the journal. Now this is what you have to do when it's periodic. So remember, they're added up and adjusted. Perpetual inventory. We are continually adjust the inventory account for each change in inventory caused by, we add purchases, that's called inventory, minus sales or returns of merchandise, plus freight in. Remember, freight out is a sales expense, plus return by customer, minus purchase discounts. You are continually adjusting cost of goods sold each time goods are sold when you're doing your journal entries. So now let's take a look at these journals. So same thing happened. We bought inventory. We're using the net method. We paid freight on purchases. That would be inventory. We returned 5,000 in goods. That would be inventory. paid for balance after terms. And again, we could either use that account called purchase discounts lost, or we could use the inventory account. You could have done that either way, but in your homework, they use purchase discount loss. So that's why I'm showing it that way. Now, then we had our sale. We would have taken out the cost of goods sold out of inventory and booked it as an expense called cost of goods sold. Ending inventory, we had beginning plus purchases uh, plus freight in minus purchase returns gave us the total cost of goods available for sale. They would have all, as we did our journals, would be adjustments. Minus cost of goods sold, we'd have an ending inventory balance of 34.3. So perpetual versus periodic. Now remember, most companies, because of barcoding and today it's so easy to do this stuff, are doing perpetual inventory because it gives them up to date all the time. Periodic is only used by very, very small, like a small mom and pop shop would use that because it's a lot of work. In order for you to figure out cost of goods sold, every time you have to go in and do a physical inventory. So for perpetual inventory, cost of goods sold, cost of goods available for sale is allocated by decreasing inventory and increasing cost of goods sold. So everything in perpetual goes to inventory. And is probably, but remember, regardless of what method, you still have to do a physical inventory. And that ends this part 1.